Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com has the latest from the markets the past week and tells us Bitcoin is behaving like the dot-coms did years back. Wall Street Windows' Mike Swanson gives us his thoughts on what's hot right now. Junior gold miners have caught his attention. Tim Cyclesman Wood gives us some insight into how we've come into what appears to be the bubble of everything. He believes it's been brewing since 2000. Market historian Bob Hoye says don't believe the people who say it's different this time. He also says lowering interest rates kills a growing economy rather than helping it. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always nice to be with you, Jim.
Ross, are we getting any oversold readings on the stock markets?
We had some on some of the individual stocks. You had a few that have missed on earnings badly. You ended up with Google taking a it's Alphabet taking a pretty hard hit. Intel took a hit in this last week or two, and these two had quite a bit of excess on the upside. And as of Thursday, Friday, they're down into what we would call as initial support areas, and probably good for a pretty good bounce in here. Although these lows end up needing to be retested, but should see a decent bounce from this level. The other area that we have seen a lot of pressure was over in the metals. Copper took a real hit during the week, ended up with prices down all the way down to about $2.77, having been close to $3 only a month ago. So that's a pretty hard hit over there. And they usually talk about Dr. Copper in terms of its measurement in terms of the state of the economy and what's going on. But when we look back on it, it's only got maybe 70 or 80% correlation with the market. And the times when it has been down, like we've seen this last month or so, when the equity markets have been strong, it's been in eras such as we saw in the late 1990s when the dot-coms, everything were doing extremely well on the upside, and you saw the more of the basic stocks and economic models on the negative side, and that went on for the better part of for 2 years, from 1998 through 2000. So I would take the break in copper right now with a bit of a grain of salt. We would need to see other things in the broad markets to say that they're rolling over. I mean, classically, that would be a test of the highs and then a failure, and that's definitely not happening right now because you got the Dow and S&P, Nasdaq all pushing up to their highs. So you'd want to see, as I say, probably a bit of a pullback, a tested high that fails and starts to roll. So you get more of a topping process or a rolling top, and that doesn't seem to be in the cards just now.
What's going on with Bitcoin?
Well, it was a year and a half ago, December, that we got all the upside exhaustion ratings, just the classic that you would see in a blow-off. It was like a tulip mania. And the implosion since then has just been an absolute classic. And in February, we put out some comparisons with the post-bubble tops of the gold market from 1980 on NASDAQ in 2000, Shanghai just, 3 years ago. And each one of those declines has very, very similar price pattern as it gets down and puts in its significant bottom. And we have all the pieces in place right now for Bitcoin to have established a very, very major low. And the first rally off the bottom was about a 50 or 60% move up to the 200-day moving average. It's had a bit of a pause for the better part of a month and a half now, and is starting to come back to life. So overall, I think it was up something like 20-25% from the lows of a week ago through the highs of this week. So you're getting much better percentage moves in something like a Bitcoin coming off the bottom right now than you are in stocks that are just managing to break out into all-time highs. And if you look back on those other implosions and the resulting period afterward, the charts just look like a steady, methodical move to the upside, and that's really what we're starting to see here in the Bitcoin chart. The 50-day moving average should provide pretty reasonable support, and you just want to ride with this newly emerging trend. Nobody wants to talk about Bitcoin these days. That was the hot topic 1.5 to 2 years ago. And now the hot topic is the all-time highs as far as the stock market's concerned. So look where the opportunities are more than anything else, I think. The other area of opportunity right now is that gold has come off and silver just enough to be oversold to the point where with this sell-off into April, which is normally an important period for the gold market, it's found a double bottom here. We've got what we call a springboard signal. That's where you've got a minor overbought within a flatter rising trend. And that pattern has a very good track record as far as gold is concerned. A reversal up through the 1282 to 1285 should have legs. So I think for anyone who is looking to be into the precious metals, they can be in here with fairly tight stops right now, just under the lows of this week. And you have a different pattern in silver. We had 9 consecutive weeks with closes below 4 weeks earlier, so that's called a sequential 9 buy setup. And on that one, we've got a really nice track record going back to the 1970s. An upside reversal here should have some decent legs in it as well.
Ross, is crude still continuing its climb, or is it flattened out?
No, it rolled over just where it was supposed to from a seasonal perspective. April, sort of mid-April through the early part of May was the optimum for a high. We put in a $66 high about 10 days ago, sold off into Friday, got down to the just under $62 intraday. You're getting a minor oversold reading right in here. We would expect to see a bounce, but the seasonal low should be more into late May going into June. And somewhere that would appear, there's some moving average bands and other oscillators that we're looking at. I think it's going to take a move down under 58 if we sort of extrapolate out here before we start to see good signals there. As far as the stocks are concerned, you look at the ETFs, the XLE in the U.S. or the XEG in Canada. They recovered about into the April high this year, about half of last year's losses. So they had a very, very good move off the bottom. They've sold off enough this week to become oversold, and they're ready for a bounce. But I think you'll see that these lows are undercut as we get into the latter part of May and into June. And optimally, that should be a major buying opportunity because we are at this point in the early stages of this bull market move that we anticipate will take about 2 years, take about another year and a half from where we are right now.
Ross, thank you so much for being on the show.
Always good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Wall Street Window's Mike Swanson next on This Week in Money.
Always consult your investment professional before making any investment decision.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Mike Swanson, editor of wallstreetwindow.com. Welcome back to the show, Mike.
Oh, thanks for having me. Interesting day today, that's for sure.
Mike, the U.S. Fed announcing no rate hike, and then the Fed chair came on and said, we're not leaning either way. We're not looking to hike. We're not looking to reduce. What does that tell the market, and how did the market respond?
Well, it was really kind of funny, and I was watching it on the television, and as they made the announcement, the stock market at first went up because inside the statement they said that there were troubling signs that inflation was not hitting their target of 2%. And this morning, Donald Trump attacked the Fed, said they need to lower rates because there's not enough inflation. And actually, a couple of days ago, one of the Fed governors talked about one day doing an interest rate cut as sort of like as an insurance policy, and saying that this was done in the 1990s before the stock market bubble appeared. In fact, some people argue the cut helped make that bubble happen. But regardless, when the initial news came out, the stock market went up, and I was watching CNBC, and there is actually a lot of excitement. Someone was saying this is like a Goldilocks moment because the Fed is no longer raising rates like they were last year, talking about one day maybe lowering rates. So it was up, but then I left and came back around 3, and everything was down. And now I'm looking at CNBC's website, and they're saying that Jerome Powell used the word transitory when he spoke to the press to talk about this lack of inflation, suggesting that it's a problem that will go away, and therefore the idea that the Fed is going to lower rates is not a definitive notion, and he actually said the risks are balanced. No one really expected the Federal Reserve to do anything today, and even if they were going to lower rates, it would be months off. I still think it's a good chance they will. The Fed Fund futures are projecting over 70% chance of a rate hike by January. So I do think something is likely to happen. But stock market people probably saw today's action as whipsawing, confusing. We saw gold come down a little bit too. The gold stocks are a little weak. But I think people need to always put these gyrations that occur on an hourly basis in context with the longer term trend of the market. And that's not to say it's going up forever, but it's to say look at the trend on the weekly basis. And if you do that, the stock market fell 20% last year. It reached an extreme oversold condition. The RSI indicator, which is one of the momentum indicators for the NASDAQ, really got oversold. The VIX got above 30 in December. There was panic in the market. That type of panic often marks the end of drops. And then we rallied, and we've been rallying up to the point where going into this Fed meeting just 3 days ago, the NASDAQ RSI went over 70 to hit an extreme overbought level that hasn't really happened on the NASDAQ for several years. The last time it happened on one of these averages was on the Dow right before it dumped last year in February when we had that VIX spike that, it seems like a long time ago, but there was that dump of over 1,000 points. So the point of this is to say that the market is extremely overbought. So to see a down day selling the Federal Reserve, no matter what it does, isn't that shocking to me. And then I'm saying this not to suggest that the Dow is going to fall 1,000 points or we're on the verge of some big sell-off. I really don't think that's the case. But it is to say that we've had a huge rally, the market's extremely overbought, and it's very difficult to really expect the market averages to have that much upside potential in the very short term without more consolidation for weeks, maybe months, and even a slight pullback. You could fall to the 50-day moving average. It would not be any big deal at all. So some people, there's a famous saying, sell in May and go away. I'm not saying that, but I am saying, if you're someone on full margin, if we're in triple ETFs, because you got excited about the market, going up, and when it does go up, everyone cheerleads it. People pile in and buy and buy and buy in pyramid. Yeah, then you may want to reduce that. You may want to stop doing it. And if you like to buy on dips, or you got stocks that you don't like, and rather buy something else, I think is the time to make changes. So, in other words, from a money management, portfolio management standpoint, when the stock market does rally like it has, gets overbought, then if you have, too much in the market, it is time to take some money off the table. Some people, I do a rebalancing system where I only want to allocate so much to various sectors, and when things go up so much, then I take some money off the table. Conversely, when something declines, and then you're not allocated as much because it's fallen in value in regards to the rest of your portfolio, then it's time to average down. So in the commodity sector, we have seen dips. We've seen gold, it peaked out around 1350 in February, and now it's pulled back below 1280. I think it has major support in the 1260 area, basically 1250 to 1260. Which is the convergence of the 200-day moving average, the 150-day moving average, and a 50% retracement point of the February high and the August low, which often acts as a major support level too. So there's three major reasons to think that's a big support level. At the same time, the commercials in the futures market are only net short around 50,000. That's a very small position. So for them, they're not looking for a significant decline. When I see gold having dropped basically since February and down today, I think it's time. If you don't have the gold you want, now's the time to buy and average in. So that's the way. I think that's what people should be doing. In reaction to what the markets have done from January to today, not in reaction to the Fed news. And really, if you think about it, what the Federal Reserve has said is they're not raising rates, and they will lower rates, at any moment if the stock market were to drop. So they're there to do that. And ultimately, I think the primary beneficiary of that is going to be gold, because we have passed the end of the hiking cycle months ago, and we saw, that the stock market drop last year 20%, told us that the end of the cycle was there and upon us, and it has indeed passed. And the words of Jerome Powell today is only further confirmation of that, but they actually said this to us back in February. So today is really nothing different than what they said in February.
Yeah, I find it interesting when I listen to Jerome Powell, how he takes so long to say so little.
Well, he's good at that, and Alan Greenspan really what he tended to do was confuse people, use very big words, words so big that even the reporters would have to go get a dictionary to find out some of the things he was saying, and then it still wouldn't make sense. With Jerome Powell, he does speak clearly and bluntly, but he goes on and on instead.
We'll have more with Mike Swanson right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mike Swanson. Mike, what's going on with the U.S. dollar after the latest pronouncement or non-pronouncement from the Fed?
Well, today the U.S. dollar actually is about even as we're speaking, but yesterday it took a little bit of a hit. And I think the dollar is probably in the process of making a major top, but it's going to take quite some time, probably into the fall for that to play out. So, if I was going to trade the dollar, and I'm not personally, I would be shorting it right here. But instead, I own and buy gold in the mining stocks because I think they're going to go up when the dollar goes down, and ultimately I think the catalyst is going to be the time when they do get more dovish or lower rates, which if the stock market drops 10% or something, they'll be doing it, or they'll at least be talking about it. So I think that's where the dollar is going to be in trouble. And I also don't think the dollar has much upside, because I think one thing that has kind of been clear since Trump has been in office is his administration seems content to try to have the dollar trade in a range, not be too strong or too weak, and it really hasn't been too weak, but they have talked it down at times. So I don't think the dollar has tremendous upside.
How much can the U.S. government manipulate the U.S. dollar, considering that it's a global currency and has impact and influence from around the planet? Well,
the biggest lever for moving the dollar is interest rates, and economic growth, and the deficit, which that's not really a lever. That's when it gets out of control. A currency goes into a bear market, and in an uncontrollable bear market. That's what happened in Turkey last year. It's what's happened in Venezuela and so forth. But the U.S. dollar is certainly not being sold off, in danger of that right now. So that means they have the levers of economic growth and interest rates, and rhetoric. And we have seen Trump use rhetoric, but perceptions of economic growth had helped the dollar last year when that economic growth was being compared with the rest of the world. So China was slowing down, emerging markets were taking a hit in Europe too. And now, I do think probably it's going to bottom out, or that trend of the U.S. economy being better than most of the rest of the world could be slowly changing over the next year or two, and that's kind of difficult to control. So then you have rhetoric and interest rates as the primary tools, but I do think they have been able to use them quite effectively over the past decade or so. But I do think that's going to change one day, but that's probably years off.
We'll have more with Mike Swanson right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mike Swanson. Mike, what kind of action's happening in the energy sector?
Well, we had a nice rally, of course, in oil stocks, in oil. In fact, it took me by surprise because last fall, oil stocks fell worse than the stock market. The XLE ETF went from a high of 76 to about 52. It was one of the worst performing sectors in the whole market. And then it did bounce back up. It's still sort of a lagging sector because, it didn't go back up to the high. And oil, has trended, back up too, sort of into the news, last week that the Trump administration wants to do a full embargo on Iranian oil, but oil was down to 42.5 December, and it's now at 65. I kind of suspect though that this is probably the level where it's going to run out of steam. One reason is that the Saudis and the Russians have now kind of hinted that they're going to take the place of Iranian oil, try to steal their market share. And also, I think the Saudis don't really want oil to go up above $70 a barrel. They would be content with it to be in a trading range, with maybe 55 the low and somewhere around here, really. And the reason why is that they learned their lesson that if oil goes high enough, then people start to look for alternative sources of energy. And American fracking companies come online, and shale oil companies come online, and biodiesel companies come online. It becomes profitable, and that steals their market share, and that's something they don't want to happen. So I think for now, oil is probably going to just float around here for the next couple months.
Are there any sectors that are really exciting right now? I guess marijuana, is that still the space that you would look at?
Well, personally, I'm most excited about the junior mining sector, because, I do own big cap mining stocks, the Newmonts and Barricks and all that kind of stuff, but the junior mining sector, kind of is outperforming, the big caps now. And some of the juniors are just breaking away and doing very well, and they've kind of ignored the drop in gold. And that tells me that once gold really turns around, they should do even better. And I don't think they have a lot of downside risk. And I think it's because they never really went up too crazy last year. But you're right. The marijuana sector outside that is definitely the one that's got the most interest among retail investors. For example, Reaugh Cannabis on Robinhood is the number one most owned stock by the most number of people in the United States, small accounts that have Robinhood accounts. A year ago, that was Apple, but now it's Reaugh Cannabis, and many marijuana stocks are in that top 100 list. I think it was in February, we were talking about these stocks. Yeah, it was February. And I was making the comment that I wasn't sure what they were going to do, because they had a big move in January, and they were likely to go sideways. And I wasn't sure if that sideways movement would represent a top or a consolidation before another move higher. But that sideways move would probably last into March, possibly into April. Well, I think we can now say that sideways move has actually been completed and has led to a resolution to the upside. for many of the marijuana stocks.
Mike, I know you like to look afield for exciting plays and not just look at the U.S. stock market. Is there anywhere in the world right now where you think people could make moves or could make money?
Well, I'm going to say from a long-term investment, and I know I've mentioned this a few times in the past couple of years, but agriculture commodities, they're still in a bear market though. There've been attempts to bottom in the past 2 or 3 years, but they've been in a bear market now since 2011. And when they finally do turn around, we're looking at a sector that can double or triple. And I think it's in the same sort of risk to reward, area that gold was in 2015, at the end of 2015 or early 2016, when gold made a major bottom below 1100. I can't predict when this is going to turn around, but I'm watching it, every single day. And when the DBA ETF, for example, closes above the 200-day moving average, and it's around 16, the 200-day moving average is about 17, then I think the trend will shift to the upside. And I can't predict when. All I can do is watch it, and I keep my eye on it, because if I don't, I'll miss that. But right now, I think that's actually the best opportunity from an investment standpoint to buy something cheap or look for something cheap that can then go up for a couple years. So right now, I would say that's my number one, ETF or sector asset class play to be watching.
Is there much action in the automotive sector right now?
Well, it's strange because I'll talk about one trade I do have on in that sector. That's Tesla. Tesla has broken down. Last week it reported earnings, and it closed below over a year and a half base. So it's a broken stock. And personally, I think the company's going to go bankrupt within the next couple of years. It has a massive debt load, and Musk has made all these statements in the past about he's going to produce X number of cars and all this is going to happen, and it doesn't happen. And then he hides that fact with some crazy hype to distract people, and this has worked. But now the stock's broken. So on Friday, when this thing broke, I tried to short the shares. I couldn't do that. I couldn't get them. But I put on an options trade, on Tesla. So I think that's a trade in the car industry. But outside that, there have been car stocks that have gone up, while that stock has broken down. So, for example, CarMax, which was a horrible lagging stock, last fall, heavily shorted, it turned up, and went from $60, it broke out and went up all the way to 78. So yeah, there are trades to be made, in the car sector, both long and short, but I think you gotta focus on individual, companies, what are they, good or bad?
Well, some analysts have pointed out that China's plans to build electric cars, they can build them cheaper. They have experience doing it. And of course, you have a government that can mandate you must buy this car. Their stocks, perhaps, are the ones to look at rather than Tesla if you want to invest in electric.
Yeah, and I don't know I'd have to research that and find out if there is, if it's easy to buy that stock, or if it's like part of a conglomerate or what. I did see something about that. There is a Chinese company, and in fact, they're trolling Tesla, and they put out advertisements on the buses, in New York City and in the, subways, making fun of Elon Musk and Tesla and saying, buy our cars. Maybe these are cars that are going to be exported into the United States. I don't know, why they'd go to that effort to do that. But they did. But they're not the only ones. I mean, I actually own a hybrid electric car. It's not, a full electric car, but when I'm driving below like 40 miles an hour or something, then it comes on, and it's a Toyota. So, and GM can do it. I mean, so I think that's another problem Tesla is certainly going to have. And this is a company, in fact, that is reducing. I think it's desperate. Just the other day, they announced that they're going to slash the prices for their solar panels. If you can remember, they bought Solar City because Solar City was going to go bankrupt. Solar City was a company also owned by Elon Musk. Yes, that's a conflict of interest. But, people didn't care that much at the time. But, these panels seem to not have the demand anymore. So he's slashing prices. He's closed down almost all the Tesla car dealerships to cut costs. But then he turns around and says, I'm doing that because I can sell all these cars on the internet. People don't need to come to the dealership because they love them so much. Well, that's the only make a car I've ever heard of like that. And I think that's just another sign of weakness. In fact, he's so desperate or whatever the word is that he's even threatened to sue some guy that was shorting the stock and got reporters or something or somebody near a Tesla factory and took pictures of some of the bad conditions, and he's making some argument that he can go to court against them. So it's interesting, but I'm not in this for the long haul. It's just an options trade.
Mike, is there anything else that we should be keeping an eye on right now?
Well, it's a funny time in the market. I don't really, as I was saying, we're overbought. We could dip, and I was saying people should take some money off the table. However, if the stock market were to dip a little bit, say the S&P went to 2850, it's not that big of a drop down the 52 moving average. This spring or in June, people shouldn't get scared either. When the market goes up like it has, the volatility shrinks, but tops take usually months to form. So if a meaningful top is actually going to be built, it's going to be a process over time, and not just if we go down a week or two, it'll just bounce back up. So there's nothing for most people. I don't think the average person in this market, I don't really think needs to worry. It's the person on margin and the person in the triple ETFs. And there are people like that now, because when the market goes up, people do reckless things or start to.
Mike, how would you sum up things then that are going on in the markets right now? The old typical sell in May, go away, or can we ever treat markets as typical ever again?
Well, I would say sell a little bit in May, and let's see what is happening in June, and buy what's down, or average into things that are at a little bit cheaper prices, which is really gold and commodities in general, and outside oil, which is, kind of rallied, and hasn't really pulled back yet. So rebalance your portfolio, and some of that could be cash reserves, for people, because, the bond market, that's the most unusual thing about the market. He says, are things different now? It's that the bond market and the stock market have both rallied up together since December. So in a certain sense, rebalancing, it isn't going to do you much, if both have gone up. And that's probably, when we look back at this time, that's going to be the most unusual thing, is how both those markets went up together, because normally they trade a little bit opposite to each other.
Mike, thank you so much for being on the show. And can you tell us where Wall Street Window is based?
I live in the United States, in Virginia, on the border of North Carolina. That's why I got this accent too.
It's very nice, Mike.
Yeah, the weather, it's like 80 degrees finally today, and it's a nice time. And I'm not on Wall Street or, in the big cities, so I like that too.
Mike, thank you again.
Thank you. Great talking with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. Our conversation took place last Wednesday. Coming up, Tim Cyclesman Wood, next on This Week in Money.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim.
Jim, thanks for having me.
Tim, every once in a while we like to kind of sit back and find out where we are and how we got here. How did we get to this giant equity bubble where markets, again, are setting new highs?
Well, that is an excellent topic, and I think you're right. It is time for a review. You know, we've talked about the bubble and you know, where we are at a snapshot in time and that sort of thing, but, you know, I think it's been a while since we did kind of a analogy of the bubble and how we got here. And not to digress too much, but, you know, let me paint a picture with this. If you go back, let's go all the way back to 2000. Because you have to. I mean, that's where this began, really. But I have said for 19 years now that the organic top in the market was in 2000. And the reason for that is real simple. I mean, number one, just looking at the volume characteristics of the market, they were, you know, textbook, bullish going into the 2000 top, and then from there, it's been a mirror image. In other words, as we went into the 2000 top, we saw volume expansion with price advances, and we saw contractions in volume with price declines. Well, since then, we've seen exactly the opposite. And, you know, I mean, that's the chart I was looking for when we were, you know, getting online here. And you can see that it's exactly the opposite. Volume has increased as price has moved down, and it has decreased as price has moved up. And so that's, you know, it's just not classic behavior. And then in addition to that characteristic change, we have, if you look at it, you know, just kind of some of the underlying economic, they're real basic, but the point is that they're, I think, very meaningful economic data. You know, we always hear these numbers about jobs and all that, but it's real simple. If you look at the labor participation rate, which is St. Louis Fed, there's a number of different sites that carry that. It's a matter of public record, but if you look at it, it peaked in 2000. And it has declined ever since. It's still, it kind of flatlined the last several years, but it still has not what you would call an expansion at all. And now it's turning back down. And in fact, it's back, you know, it's still hovering in late 70s levels. So that peaked in 2000. And then if you look at the velocity of money, the velocity of M2, again, that's public record. It's not, you know, anything someone's making up. You know, it peaked prior to the top in 2000. It peaked in mid-97 and kind of formed what you'd call a non-confirmation, kind of gave a warning going into that 2000 top. So the organic top, I maintain, because, I mean, I just don't think you can explain otherwise, or not you, but anyone, that the organic top in the economy was 2000. And so then the stock market rolls over into the low in 2002, and that's where the funny business really got started. And when I say funny business, the monetary policy to reinflate. And obviously that happened. And we saw the run-up in housing prices. We saw the run-up in commodity prices. Gold went crazy. Oil went to an all-time high. The stock market went to an all-time high in 2007. They extended that 4-year cycle. And, you know, of course, you and I weren't doing interviews then, but it's on public record. I said, look, this is not good. It's making matters worse. They've extended this cycle, and we're still, when we turn down, we should go down below the 2002 low, which is exactly what we did. So we get into the 2009 low. What happens? Even more of the same stuff that put us in that position in the first place. And if you look at these underlying, the real underlying, some of the, economic indicators, like I said, job participation, the velocity of money, volume characteristics of the market, and so on and so forth, nothing's changed. It's just gotten worse. And so this entire bubble this time, coming out of the continuation or further expansion of the bubble, I should say, coming out of the 2009 low, has been by and large just in equities. We see less and less evidence of the inflation. I mean, look at gold. Has it done what it did back then? Housing hasn't quite recovered. It's at least not here. I mean, yes, the housing prices are up, but it's not like it was in 2007. Look at commodity prices, oil particularly. We're not seeing that reinflation, broad-based reinflation like we saw with the first go-round. So I think that we're seeing less and less bang for the buck, and this time it's being camouflaged and covered up with equities. And now here we sit at we had the decline into December, which I think was in a higher degree, much higher degree, as it was like in my world, it's label it a 4-year cycle low. And here we sit, and I think it's in inflate or die. I mean, literally, it is inflate or die time for this bubble. I don't think there's much middle ground at this point. It's been a bounce out of those lows. It's been a good one. I mean, not minimizing at all. I mean, I had obviously intermediate term buy signals coming out of that low, not denying that whatsoever, and still do. I suspect we'll get some intermediate term sell signals probably early next week. I don't know how the market closes tomorrow. May end up with them on Friday if we're down some on Friday. But I do think we're at an intermediate term top, and so I guess I'm kind of losing my train of thought there. But what I'm saying is I'm not standing in the way of this intermediate term advance that has occurred. I'm just not convinced that it is the reinflation. I think at this point it's just a bounce.
We'll have more with Tim Cyclesman Wood right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN.V. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's going to happen with interest rates? We just saw the Bank of England keep their rate at 0.75%. The Fed didn't move. The Bank of Canada didn't move. What's going on with interest rates?
Well, I think that ultimately they will have to lower. I think the market will force them to lower. When I say the market, I don't mean equities. I mean the short-term interest rate market. I have Fed data, interest rate data going back, short-term interest rate data going back to 1943. And when I say short-term, I'm talking about the T-bond rate and the Fed hikes and cuts. And what you can see is that the Fed clearly follows. In all of that data going back to 43, there was one incident where they actually led the trend of the T-bill. Now, of course, it's kind of like the chicken and the egg. Some say they can influence that, which I guess indirectly they can, but the fact is they follow. And so I think the market is going to force rates lower. I don't think we're there yet. A lot of people were thinking that they would cut this time, and I know Trump's been screaming for them to cut. And I think that the perception of lower rates is that that's going to be a positive for the market. But I think that this is a little different this time in that it's going to force I don't want to give away too much of the material that I'm covering in my letter before my subscribers even get it. But I think that what it's going to do is it's going to cause some problems with the yield curve, and it's not going to be positive for the market. When they start cutting rates, I think that's a sign that the market's in real trouble, or beginning to be in trouble, let's put it that way. And I also think that the fact that Trump is requesting the Fed to cut is a sign of trouble. I mean, if things are so great, why does it matter if rates go up a little bit? So the fact that they're even talking about it, the fact that the Fed got, as they say, dovish back in December, well, why did they back up so quick? And I think that the actions is a warning that things are they know that it's on thin ice. There's no question about that. And I think it's a matter of how well they can contain and reinflate, this natural advance out of this 4-year cycle in equities with interest rates, and reinflate commodity prices. And if they fail to do so, which I think declining rates is going to be an indication that they have failed or are failing, then I think it's going to be a sign of the beginning of the end. And I think the completion of the setup to cap this bubble. And on the bubble, I don't mean to ramble, but I left out an important point. I'm going to cover this in detail in my letter, but there is some long-term economic cycles going back. We're in the 6th long-term economic cycle since 1800. I have the data to support and prove that. You can see it looking at a chart. And the thing is that this entire bubble, when I say bubble, this entire round of monetary policy since 2001, 2002, I say that because commodities bottomed in 2001, equities bottomed in 2002. This entire round of monetary policy since then has been what has fueled this last long-term cycle up. And it's not been based on jobs. It's not been based on a sound economy. It's been based on monetary policy, and it is a bubble. And it's an illusion. It's a facade. It's not real. I was there in the dot-com bubble. I remember the economy in the 80s and 90s, and you can't blow that smoke up my butt now. It's not the same. So, we didn't have NAFTA and GATT then. You still had a sock manufacturer in North Alabama. You still had a headlight company and, making headlights at these local guys, but you still had jobs then. You don't have that now. So this is a different environment. It is a facade. It has been based on monetary policy, and I think that when interest rates start to come down, it's going to start to be a key.
We'll have more with Tim Cyclesman Wood right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's going to happen with energy?
Energy, energy and gold are kind of related, from a cyclical perspective. But, people tend to hear a piece of your message and not the whole message. I've said that the bounce out of the December low in crude oil was counter trend. That's not to negate the bounce. I had intermediate term buy signals in conjunction with that low. It was a 3-year cycle low in commodities. I mean, and I think the bounce is now at a position where, it's going to try to take hold and turn along with equities. What happens to there? I have to see. I think it's counter trend. And I don't think that if the turn does take hold, which I anticipate that it will, but I got to see it. But if the turn does take hold, then that too is going to be a sign that the reinflation is not happening. Oil prices are nowhere near where they. I mean, what were they in 2008? They topped at $142 or something like that, 44, whatever the number was. And so that's another good point, that none of these additional reinflation efforts have shown themselves in other areas. It's just been equities this time. Each of these periods of reinflation has been less and less and less bang for the buck on a broad-based sense. But of course, yes, it's blown equities up, and now they're kind of, like I said, the last man standing, and they're camouflaging the whole thing as far as the bubble top that has been trying to take place for 19 years now, and I think we're getting in a position where the rubber can meet the road, as they say. As far as gold's telling us that there's no reinflation. The 9-year cycle top has been in place. We talked about that. We had the advance again out of the August low last year. It rolled over. It peaked in February, and we've seen weakness since. Look at gold stocks. We've seen the same thing. These are signs, but everybody's so mesmerized by stocks, and they're back at new highs, and everything's so good. Yeah. The process is so vast that no one can see it.
Tim, is this a case of people confuse economy with the stock market? If the stock market's doing well, obviously the economy must be great.
Absolutely. Because like I said, man, I mean, we all know. I mean, anybody past the age of 25 or 30 should know. I mean, and like I said, in the 80s and 90s, there were still, the process had begun. I mean, obviously it didn't happen overnight. It was even better in the 60s and 70s as far as jobs. But over time, the jobs, I mean, we don't have the jobs that we had even in the 80s and 90s here. That's a fact. Any small town in America can prove that point. And so this has been, like I said, basically a monetary driven phenomena.
When it comes to money, what's the picture for the U.S. dollar?
Higher. There's obviously, any kind of trend ebbs and flows. And I think that we may even be at like a juncture where we get an intermediate term top in the dollar and could see some weakness. And I know that every time the dollar shows a little sign of weakness, people, the gold bugs, and I don't mean that in a derogatory sense, but the people say, oh, this is it. The dollar's going to roll. The dollar's going to roll. No, I'm sorry. I'm just not in that camp. I think the dollar is going, until something drastic changes, the dollar is going nowhere but up. We had those long-term cycle lows back in February. I've lost track now. When was it? It was in February. It was February last year. I think we talked about that a number of times. One of the great surprises that, however you asked me the question, I remember you asking what did you say? Something to the effect of what would be one of the least expected, trends or something for the year. And I said the bottoming of the dollar and the rising dollar. And that's exactly what has happened. And I don't see that being over yet.
Tim, anything else that we should be looking at here in the big picture?
No, I mean, it's such a process that no one believes anything anymore. They can't see it. It's literally an analogy to not being able to see the forest for the trees until you start to peel the onion, and then, you can kind of, dig into it and look at it. And if anyone wants to do that, I urge you, I'm putting my heart and soul in a really good letter, I think, this month, to try to, I try to build with the letter. I'll do, present a piece of data and another, and paint a picture and show evidence and details and data. And it's not just an opinion. I mean, it's based on data. And so I'm trying to put together, kind of pull some ends together in a letter this month and show why I'm saying what I'm saying, and present some things so people can see the big picture. So, if someone is interested in some solid research, it's available.
Tim, thank you so much for being on the show.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Coming up, market historian Bob Hoye, next on This Week in Money.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to This Week in Money, Bob.
Yeah, good morning, Jim. It's good to be with you and also with our listeners.
Bob, we've been taking a look at how the markets got into this situation where there seems to be a bubble of everything that's either growing or bursting at this moment. Have we been historically in a situation like this where really things have been brewing up to this point since about 2000? Such a lengthy growth in the markets.
Oh, yeah, there have been great financial bubbles in history, going way back, and they appeared suddenly in England, where with what has been called the South Sea bubble, and that was in 1720. And there had been bull and bear markets in London before that, and even before that, Amsterdam was the financial market. So you got a history in Northern Europe of financial markets right back to the 1300s. But when they brewed up the South Sea Company, it was a quasi-government company, and it had been following a long and expensive war. England government finances were way offside, and its notes and paper were very much discounted, and somebody came up with a scheme that the South Sea Company would raise money and then buy discounted British paper at par, which was a hell of a deal, and they worked it out when they had options and all kinds of things. So it became a full-fledged mania, and then it blew out and collapsed. It was followed by a long contraction, and this has been the case on each of these great bubbles since. Like 1929, that's another one that is widely known, and that was number 5. Number 4 was a bubble that blew out in 1873, and they have all had similar characteristics. A lengthy bull market, 8 or 9 years, and then the trend becomes very convincing and goes up very steeply, and which is a sign of compulsion. You just got to be in. And one of the other things, even with the South Sea Company way back in 1720, new issues. Everybody realized, I can do a stock. So there were so many new issues coming out in London in 1720 that the government could see that the buying was going into other companies and not into driving the South Sea stock up. So they came in with the Bubble Act that prevented new issues of bubbles. So here today you've got a big new issue stock come out, initial public offering on something that's developed a meatless type of meat And the stock is sorry, I haven't got it in front of me now, but the stock has had a huge successful opening, big gain in price from the underwriting level and volume and everything else. So there have been a number of new issues, and this is one of the things that help determine a potential top in the stock market is new issues. And of course what happens there is that they have to be paid for. So you take the money out of your account at the brokerage, and then it goes into the treasury of the new company. So it kind of goes out of the market for a little while, whereas if regular traders, they sell a stock, somebody else has bought it, and then you take the money and you buy something else. So I have this theory that I can't prove that when it's a new issue market, the money kind of goes out of the market for a little while, and it sort of sucks up a whole lot of liquidity. So who's to say when it's going to end? But one of the things you like to see as part of ending action is a IPO or a new issue market that's very hot, and this is what's happening. It was pretty good. The length of the market, this one really started in March of 2009, which was the end of that bubble, or 2007 when stocks hit their high, 2008 when commodities hit their high, and then there was another commodity rally up to 2011, and on that one we have a sort of a strange indicator. We call it the momentum peak forecaster, and it relates to the credit markets, and it gave a really big sell in 2011 on, and what it does is when it gives a sell, the hottest items are getting the sell signal, and the hottest items then were gold and silver, and base metals were very good, and also crude oil was on a secondary rally because it did its really big number in 2008. So each of these, the greatest financial bubbles in history, ran for about 9 years. And this one is extending. It's getting quite long. And you'll know that we had a very energetic high in January of 2018. That's with the New York Stock Exchange Composite Index, as well as a world stock index that doesn't include the U.S. calculation in it. And neither the NYSE comp or this world index have made new highs. And the more popular indexes, such as the S&P and Dow or whatnot, are making new highs. But it's interesting to see just how much longer this can go. You have extremely high valuations, whether you value it against GDP or against, like I have a friend of mine that does it against the average wage in the U.S. Valuations are higher than reached in 2000 with that crazy dot-com bubble. So you've got high valuations, and we've had some very good momentum surges, and we've also got very good on sentiment numbers. So there's no question that the stock market is very popular. And then we can fall back on a very old saying in the financial markets, is that the stock market never accommodates the desires of the crowd. And there's a certain degree of sophistication there because it's the crowd that makes the stock market. And if the crowd has decided it's going to go up forever and is in, that's typically kind of close to the top, and you come down to a simple question. If everybody's in, who's left to buy? So we could be approaching that for this year, we were, well, once the market, well, let's just go right back to last year, where in the summer, there was enough things going on to conclude that there could be a liquidity problem in the fall. And then using our historical work in the 1825 bubble, that problem then, it took actually right into Christmas before that problem was solved and the markets were cleared. The last of the offside accounts were pushed out. So this is what we had for last year, that a liquidity problem that could last until Christmas. And then on December 26th, we had our technical work on the S&P, and it was down to a capitulation. And then also at the same time, the crude oil price was down to a capitulation. And that's where then we looked for, it would be a good rebound. And the rebound could run into March. And then in March, we looked at crude oil and felt, no, it could go maybe into May. But in March also, it looked like the rally in base metals had run its course. And you'll recall that we call them our friends of the rally, which would be industrial commodity prices, the credit markets and things like that, the yield curve and credit spreads. So these were likely to be positive into March, and in March we noted that the base metals had run its course, had some energy on the upside, and would probably, maybe that would be the best for the year. Then this week, with the decline in copper prices, there's been a number of services and analysts have come out and said that Dr. Copper has given a sell signal, perhaps, on the economy, this kind of thing. And yeah, I don't think that copper has any unique distinction there. But you take them together, the base metals did rally when it was likely, and they reached what seemed to be a peak, and they're declining. Now, the people get disturbed by rising crude oil prices and rising gasoline prices and like that, but rising industrial commodity prices tell us that the boom is on. And then the other one that gets worked over in the media is the horror shows of rising short rates. That, oh, this is awful, and you've got Trump pushing the Federal Reserve System to cut rates. And the irony is that so long as short rates like Treasury bills are going up, it means that the boom is on. And when they go down is when the time to be concerned, because in looking back at history, you had, in the infamous year 1929, you had the Treasury bill rate increased till May of 1929 and started heading down. And by the time it was down noticeably by August, that then was saying that the boom was over. The stock market had its high in early September, and then the rest became history. But the establishment in the financial markets gets weird ideas. They think that rising rates are bad. No, rising rates tell you the boom is on. And then they think that the Fed will wave the magic wand and lower its administered rate, and that will then restore the boom. But 300 years of history points out that short rates go up in a boom and down in the bust. And recently, the talk that the Fed was no longer going to be raising rates has been a positive for the stock market. I haven't seen a big name spokesman yet come out and say that the decline in rates will get the boom going again, but there sure was a good one in September 2007. A guy says, it's a certainty the Fed will lower rates and the good times will continue. And at that time, I just resorted to history and said that not only do interest rates go down in a bear market, but the worse the bear market, the faster rates go down. And then also in 2007, you had a leading Harvard economist, Greg Mankiw, in that December said that really nothing could go wrong because the Federal Reserve had, and his term was, a dream team of economists. And the irony is that December was the peak in that economy, and then you started a contraction that the popular media eventually described as the worst contraction, the worst financial calamity since the 1930s. So you don't want to look at what the establishment is saying when a boom is very popular.
We'll have more with Bob Hoye when we return. Plus, we'll have the answer to a listener's question.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with market historian Bob Hoye. Bob, how often have people said during a big bubble, it's different this time? The good times will continue forever.
I'm sure, Jim, you can find that at the peak of every bull market. It is a crowd phenomenon, and you have a prosperity there. Even people who are not directly playing the stock market sense the prosperity because you have the boom, you have people working, and I just saw some numbers this morning that in the U.S. Unemployment figures are the best in, generations of people, which is I think so. These booms feel so good, and people don't want to see it end. And what one needs to do is just be absolutely clinical about it and say, okay, and this is where technical work comes in to measure the excitement, and then also the historical stuff that if you're familiar with previous great bubbles, then you can get a little clinical about it and say, okay, but there are those who are enthusiasts today, Wall Street spokesmen, who know that this is that, hey, when this is exciting, but the forces are very powerful to say, yes, but it's going to continue. Then you have to come up, and then you actually are saying that this time is different, and I think I found one recently here. But you've got some pretty spectacular stuff going on. I grabbed some headlines, and on the real estate side, which had been a terrific boom, and then on Long Island in New York, you've got there in the East Hamptons, which is exceptionally high-end and beautiful place. And here's a headline: unsold luxury homes are piling up in the Hamptons. Another one: lush vacation homes are losing their luster. And here's another one: mansion crisis, Hampton home sales tumble to a 7-year low. Now, when the people who could afford to buy those places were buying them, they could see no problems on the horizon. And then all of a sudden it turns. And then here's another headline that 1 in 7 homes in Japan is empty. And it amounts to millions of homes. And then also I saw a headline that in China, 1 in 5 residences are empty. So it looks like it's overbuilt. And then the first, well, this stretches out, but and again, the Reuters on April 30th had a really good headline. S&P posts the best 4-month run in nearly 9 years. So let's go back 9 years, and of course that would be the rally that came out of the crash that ended in March 2009. And those kind of disasters are followed by, once the problem clears, by very sharp rallies. Now, that rally came out of a stock market that was underpriced because it got devastated, and everybody was insistent on getting out. And they got out, the last guy got out, and the market went up. So this one, of course, is a rebound out of rather a bad hit down to Christmas time. And there were some pretty dismal headlines with that one. Oh yeah, here's one I found here, December the 10th, just last December. World markets in a world of pain as nothing can stop relentless stock selling. And then, of course, now you've got the best 4 months run, and it's not going to end. So one should be circumspect, and this is, and one should also not get excited and passionate about your positions. I know what it's like. When the market is blessing you, it is wonderful, but you still have to step back and say, okay, I'm going to take some money off the table. And it's a difficult thing to do because you can never get the top trade, but you just have to say, okay, these prices are very expensive. You've got momentum, you've got sentiment, and you also got measurably high valuations. So everybody wants to, of course, get out at the top trade, but you can't. So then you build liquidity while you can, and let's say Mother Nature is blessing us with the opportunity to take some money off the table and put it aside and wait and see when the excitement will leave. And as I said, these contrasts in headlines from as nothing can stop relentless stock selling at Christmas to now the best 4 months run in 9 years. So I'm going to repeat myself. It's time to take some liquidity off the table on stocks that have had great success and put the money aside. We'll be watching, of course, for signs that the market's starting to change. And we have our set of indicators that have worked on previous peaks of bull markets, and that would be crude oil going down as it was reaching its recent high last week. We noted the technical excesses. After mid-year, you can start to look for seasonal lows for crude oil, which is typically in December or January. Seasonal low for copper can sort of be in November. Seasonal low for lumber can be in October. So these are the industrial commodities that have been friendly to the market in the first 4 months of the year. But then they have an ancient history of being unfriendly after mid-year. So it's like we did last summer, where we noted that in the financial markets, the sunshine could run through till June, and then by August turn to twilight, and then we use the term that in the fall it could turn into the scary twilight zone, with duty, duty, do. And it's the same, something similar happening this year. Tremendous excitement, great positive attitudes, but then after mid-year, we've got today's sunshine, could turn to twilight, and then we could get another twilight zone in the fall, because these seasonal forces are ancient. They're built in. I know there was in 1300s in Florence, in the northern city-states in Italy, that was the financial center of the world. And while they may not have been trading stocks, there were mortgages that traded. And then there was too many mortgages created, and then not enough bidders, and the collapse was quite extensive. And there was a historian, Italian historian by the name of Cipolla, who wrote a very good book on it. But one of the things you get from reading that was that the worst times in working out that liquidity crisis was in the fall, and that was 1346, I think it was, and before the Black Death came, so it had nothing to do with that. So it was just a fall item. And then going back even further, the writer and statesman Cicero in Roman times, and he had a very clear description of when you had a financial problem, as he called then, in the eastern provinces, meaning the eastern Mediterranean, that eventually that financial disaster in the outlying regions would come in and hit the main money market in London, London, New York, Rome, they're all the same. And indeed, that did happen. And one of the things that makes me nervous now is that the problem that this began a year ago with a financial problem in Turkey, and also there was one in Argentina. Well, these have continued, and it's now 1 year since that initial hit in Turkey, and that hasn't been fixed. And we've seen with the Asian crisis in 1997, where a problem in Thailand, where the central bank ran out of liquidity, eventually, well, then it took out the Philippines, and the financial press then advised the world that it's no problem because it was isolated to Thailand. And then when it hit the Philippines, then the word was that, this could be contained. And then eventually in that September, it hit New York, and they had the worst month in the corporate bond market in a decade. So there's nothing new in history, and in financial history, and there are a number of, let's call them, Jim, problems on the horizon that we're watching for, and there is a fairly similar path on the way up to a great speculation, and then the path out of that great speculation is quite similar as well, and it always has the fall as the time when, there are no bids, and people then have a problem. And do we want to look at that question?
Yes, Bob, we have a listener question. The markets are up approximately 20% since the beginning of the year. Are we looking at a triple top, or can stock buybacks power this market higher?
Yeah, you look at some of the S&P, and there is a big triple top there. But the question also includes about the new issues and IPOs and this sort of stuff. And as we reviewed a little bit later, this is all part of the most fun part of a bull market. can be new issues, and we have a new issue market, and we're capable of finding perspective in this, both from a historical, like a way back, and then to seasonal, which is always a good help, and then to technical, which gives you the excesses. So what we're watching for here is the transition from the very good times to a liquidity problem, and I think we're on the path for that, and our coverage on the credit spreads and the yield curve will be very helpful. And probably after mid-year, there should be some reversals that would give us a pretty good warning. And that's the best that you can do is to kind of identify the extremes and look for the time when they could likely change.
Bob, thank you so much for being on This Week in Money.
Well, Jim, I enjoyed it, and I do like the questions.
And if you do have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mike Swanson, Tim Cyclesman Wood, and Bob Hoye. And thank you for listening. Now stand by for company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's always great to be on the show, and I'm happy to be chatting with you this morning.
Larry, some economic news or fiscal news from American Manganese. What is it?
Well, we've been working on a private placement. It's just been a grueling job, and we've closed it and oversubscribed for about $1,557,000. So that puts us in pretty good shape for the next tranche, and that's also going to get us sitting back at the drawing table here and wondering what way to attack this. And I think I've mentioned that going bigger is one of the ways to make a tremendous amount of money, for one. But the other thing is it brings down the operating cost, and it's actually the CapEx, the capital required to get the project going, is for something that's 10 times bigger or 15 times bigger, is probably only about 3 times or 4 times the amount that's required for a small plant. So we've got to put some numbers around that. We'll be talking to Cometco on moving forward on a plan that incorporates. We know we can get 40 tons of scrap a day, so we want to look at optimizing our opportunity here. And we're talking to various groups about joint ventures, everything else, because if I wanted to put my whole wish list out there, it would include the not just the recycling, but the manganese project in the United States, where we have a patented process in 4 countries that is an answer for some of the shortage of manganese metal or manganese dioxide in the United States. There's no domestic supply, and that's going to become, in my opinion, that will become a very salient point moving forward. And for that, we're going to require a partner. And, we've developed the technology. We've identified resources. And now the partner can come in and put put it all together. We did a pre-feasibility on it. So there's a baseline there that you can work from. And I think it's time to start dusting that off, not mean that we're going to, divert a lot of capital to that right now, because the important thing is our recycling and our recyclable process. So that is something that we want to, not take the eye off the ball on that. So, yeah, it's exciting. I mean, you look at all the articles, and a lot of them are still talking about there's not a lot of money in recycling. I don't know where they get their numbers from, but it's not hard to figure out there is a lot of money in recycling specific metals like nickel, cobalt, lithium, and manganese, and for a small part aluminum. So there's a lot of value in those batteries, and we can unlock that. I notice they're starting to call the metallurgical process a wet process. It almost sounds like I won't even go into that, but a wet process to me is not a way to describe the metallurgical process. There's a lot of science involved. And, it's not like you spray it with water and everything drops out. So it's not a very descriptive way of talking about the recycling of batteries using metallurgy. But, we've got other meetings planned for later this month at Cometco, people that are interested in our process. And I think it's just a matter of time until people begin to realize that they've got to do something, not just talk the talk, and that we have an answer. We have the only patented process out there, and I think our shareholders can be very happy that we managed to get that and expedite that in about 13 months. We got another patent pending, which I expect in a very few weeks, maybe 2 or 3, that we will get that patent, which would be a record. And I think that American Manganese is doing, the management are doing everything they can to keep this thing on track. And, now we don't have the diversion of raising capital in a tough market for the next few months. So let's get on with the work.
Larry, for people new to American Manganese, what are you all about?
American Manganese, through its branded subsidiary Recyclical, has a method of recycling lithium-ion batteries, whether they be EV, whether they be phone batteries or laptops or handheld devices. There's a huge market out there. Of course, that one, rounding up the material, is going to be a fairly difficult job, but when they enact a few laws in the United States, and where Europe is already adapting to that, then that will become commonplace. You'll probably get 60-70% of all those batteries recycled. That sounds a bit low, but that would be a goal that I would shoot for. Now, basically the cornerstone of our whole operation has been the metallurgical process we developed for manganese in Arizona, and that's been the cornerstone of everything that we've done. So just to give you a brief update on where the company's at, you can get any information that you require at AmericanManganeseInc.com. That's our website. You can check us out. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM. You can phone the office here at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
Thank you.
My guest has been Larry Reaugh, CEO and President of American Manganese. Our conversation took place on May 3rd. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back to the show, Jim.
Thank you very much, Jim.
Jim, you're just back from Arizona. What was going on there?
Well, there was a Capital Events Conference down there, which is a one-day speed dating event where you meet 20 new investor groups in one day. Every 20 minutes, you give them the pitch, and then they move to the next table. And it's exhausting, but it's actually invigorating. Especially this one. This one was good. This one was very good. Best I've seen. A lot of the Americans there are they're either brokers, representatives of certain brokerage firms. Most of them are family funds and LLPs. And partnerships, and the way they've evolved, I guess, is brokers have left the industry, taken their clients with them, set up these LPs, and started, as partnerships buying stocks. And so the head guy, maybe the past investment advisor, is the one that's there. He's asking the questions. Really good. And their interest level in resources has gone up. I was warned by another fellow I know the week before, who actually is, he's putting a fund together up here in Canada, and he said the interest in the States has just absolutely gone bonkers. So I found this out a couple days later at this conference in Scottsdale, and the interest is really good. As a matter of fact, I've been invited back to New York, back to Palm Beach and that, where these guys are located, to come and talk to their people.
Jim, for people who are new to Aben Resources, what are you all about?
Aben is it's a gold exploration company. Safe jurisdictions. We're located in northwestern BC, which is the Golden Triangle. We have another project that's drill ready right now, is the Justin project in the Yukon. And right now, that's it. That's a full plate right now. But it's important that we be in safe jurisdictions. I like things closer to home. I know what's going on. We've got something up in the Golden Triangle that's pretty unique. It's an area play. There's a lot of companies up there this year. And I was at a conference in Kamloops not too long ago, and the minister was there, the mining minister, and talking about numbers that have been spent last year. It was $165 million spent in the Golden Triangle. It was by far the largest percentage for all of BC. Like, total amount for BC was around 400 million. And they expect it to grow this year, which is nice. It's really good.
Where is Aben traded?
Aben is traded on the venture exchange, the tsx.v, under the symbol ABN, and under the QB, OTC QB, in the States under ABN.V.
And if people wanted more information about Aben Resources, where would they go? Well,
they go to the website, www.abenresources.com. It's a great website. There's tons of information on it. And you can go to the news section or the investor section and hear all the interviews that I've done and get an idea of my ideas, that sort of thing. It's really good.
Jim, thank you so much for the update.
You bet. Thank you very much.
I've been speaking with Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on May 1st.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.